The most famous of them is the inventory turnover. Their point is to figure out how much of assets do you use to generate certain sales. Okay. Ideally, you want to use as little assets possible to make as much sales as possible. We're going to look at things like profitability ratios. These are things like profit margin, net income divided by sales, or return on assets or return on equity, per dollar of equity, which is kind of book value of your investment. How much money do you make? Or per dollar of assets, how much money do you make? You have growth rates. We're going to look at things like internal and sustainable. The internal growth rate says, given that everything else about the company is the same, what is the maximum amount of growth you could achieve if you use only internal resources? Which means you could only use retained earnings. For example, a company that distributes all of its earnings as dividends will have an internal growth rate of the same. You're not adding any resources. Sustainable growth rate says, okay, I'm going to allow you to borrow, but only to the extent that your debt equity ratio is the same. And we're going to look at things like price multiples. These are ratios of price per share with something. Do you guys know of any ratio like that? You divide the stock price by something. Have you ever heard any ratio like that? Have you heard something called PE ratio, price earning ratio? If you're interested in investing in anything, you must have heard it. In fact, a lot of people use PE ratios to make investment decisions, which is utterly dumb. That means you don't know anything, and I'm going to go through why that is utterly dumb. Example, PE ratio is price divided by earnings per share. But that assumes that it basically means if earnings per share were to remain the same, price earnings ratio tells you how long it would take you to recover your investment. I'm paying $100 for this share, for example. Let's see how much. Let's do. In fact, I'm going to look at the analysis page. Basically, these 43 analysts on average think that NVIDIA is going to make $2.84 per share for fiscal year 2000. If I divide 100 by that, I get the so-called forward PE ratio because I'm using forward earnings. That's roughly about 38. So based on that, it's going to take me 38 years to recover my investment in NVIDIA. Normally, that's a bad number, okay? But the crucial assumption or supposition in that statement is if earnings were to remain the same. Oh, for example, in 2026, they're expected to make $4. You look at the analyst growth estimates. Over the next 5 years, analysts estimate that NVIDIA is going to grow over 50% per year. That means about 8 times The earnings are going to keep growing. When we look at those, we're going to say, okay, how do we take that growth into account? For example, if I looked at the same number for Microsoft, they're $413 per share. They're expected to make $13 next year. So that's roughly what, 30? So based on PE ratio alone, Microsoft's cheaper, right? If I were to trust that growth rates were going to be the same, there's a simple trade: buy Microsoft, short NVIDIA. Shorting a stock means you sell a stock that you don't own, you borrow some funds. Usually your broker arranges that. When the price goes down, you buy it back at a lower price, you make money. You still buy low and sell high, but the order of buying and selling is flipped. But let's look at the just 1 year growth rate. In 2026, it's going to grow only by maybe 15%. On the other hand, NVIDIA is going to grow about 40. Analysts expect that next 5 years growth for NVIDIA is going to be 14%. It's still higher than the estimated growth rate of the S&P 500 companies, but nothing near NVIDIA. So in fact, I calculate for my own analysis something called growth adjusted PE ratio, which I'm going to show you guys anyway. Even though you're not going to take any investment stocks at the bank or credit market. On a growth adjusted basis, if Microsoft price is correct, NVIDIA should be at least $175. So that trade is also obvious. If you believe those growth numbers, which could be a big if, buy NVIDIA, sell Microsoft. That's what price multiples are. I mean, in addition to PE ratio, we also look at something called price to book ratio, which I don't particularly care much. We also look at price to sale, or something called enterprise value over EBITDA, which is somewhat sophisticated. It's similar to PE ratio, but it's leverage out of the calculation. It also gets rid of things like essentially operating earnings, operating cash type earnings. I got about 30 minutes, so let's start with short-term solvency ratios. Come on. The mother of all short-term currency ratios is the current ratio, short-term solvency ratio. The purpose of short-term solvency ratios is to get measures to communicate to short-term creditors how likely is the firm able to cover its short-term obligations. That's the purpose. Current ratio basically says take current assets divided by current liabilities. We can also rewrite this. I'm going to creatively add a zero to the numerator. And this becomes 1 plus. And we recognize the difference between current assets and current liabilities as net working capital. Remember, current assets are assets that can be converted to cash within 12 months without sacrificing much value. You can convert anything into cash in 12 months, but you may have to sacrifice some value. get ahead. And current liabilities are your financial obligations that are due within a year. You automatically think that, this thing should be at least greater than one, right? If I was giving this lecture in 1979, I would have completely agreed. Back in 1979, I would have want to lend or shut down any money to a firm that didn't have a current ratio less than 1.5 or more than 1.5.